And on the bond side, we have a steady trickle of people selling their bonds. It's like sitting in a smoky cinema queuing up for the exit. The stampede hasn't started yet, but there could be a stampede and it might go downwards. The bond prices might go down very quickly. So if I was a holder of bonds or a bond fund, I'd be out.
Tuesday, August 22nd, 2023, Maneco 64, home of alternative economics and contrarian views. So this morning I have to thank Clive for coming on short notice. I have to do this video early today, but I was thinking about the bond market yesterday because some of you probably saw the 10-year yield is making new highs. It's breaking the high from last year. I saw the 30-year mortgage rate in the US approaching 8%, which is probably the highest this century. And I always remember Jim Sinclair, who was Mr. Gold in the 70s and the 80s. I started following his blog back in 2002 when I first bought gold. And he always said that there are some pillars for a gold bull market. And one of them was a bear market in the long bond or in US Treasuries. And we haven't had one in over 40 years, but now I think we do. And that pillar, I think, government bond market pillar is cracking and breaking. And unless the central banks come in and save the day with more QE, I don't see that changing. And why is that important for the fiat currency regime and also important for gold and silver? Well, because it's the base of the fiat currency system. And Clive, I was thinking the other day, I wanted to ask you a question because you were a wealth manager at private banks for like 40 years or so. And I just wanted to ask you what changed your mind, or have you always known that this system is fragile and that ultimately gold and silver are going to be the places to be? So it's like two questions here. You can answer the second one first if you want, and then we'll go into the bond market.
Well, answering the second one, Mary, I acquired my first gold sovereign at the age of 14 from my grandfather, and he told me never to sell it, and I haven't sold it. And as of today, it will buy me as much as it would have bought me back in the 1965 or 1970 when I got it. So it's worth about £400 today, I think. Back when I got it, I went to Sharps Pixley after I reached the age of 18 in London, and they told me they would give me £10 for it, or I could buy another one for 25. So it's gone from sort of somewhere around £15 to £400 or £300 now. So it's held its value over time. In terms of telling my clients about the monetary system we were in, there was a time way back, and it's as far back as I can remember, maybe 30 years or more, that bonds were a pretty good thing to own because you could get a real rate of interest which exceeded the inflation rate, even after paying your taxes. And so there was this magic word we used, the magic of compound interest. But that's all gone away now, because we now live in a world where the interest rate is below the inflation rate almost everywhere. I know we've got some official numbers in America showing the inflation is about 3 and the bond yield's about 4. But realistically speaking, we know that that CPI number is not really real. So we're living in a world where if you own bonds today, you're going backwards. And that's going to be faster and faster because most governments are very indebted and they are planning to spend more than they collect in taxes going forwards, which means they'll have to borrow more and more. Simply put, that means your share of the wealth, if you're owning bonds or cash, is going backwards.
Yeah, and maybe you could explain to the viewers how detrimental it's going to be for a lot of, not just the central banks, because they've been buying bonds for the last, since 08, 09, but also pension funds, defined benefit pensions, like all kinds of institutions. They've been told by the regulators that they have to have bonds because it's the safe place to be. But it's anything but now.
Well, there's a limit to how much these pension funds can buy. Every pension fund, every investment manager has his own set of rules as to which he's going to adhere to. So I'm going to talk simply about what's called the 60-40 portfolio, where you have 60% in equities or 40% in bonds, or the other way around. So it's all very well for the regulator to say to the pension funds, you should buy more government bonds. But there comes a point where they really don't want to, and they're going to do anything they can to not do that. And I think what we're seeing at the moment is a bit of a paradox, because the supply of bonds is going up. There are more bonds in the world today than there were yesterday. And the reason for that is that the governments are borrowing to fund their deficits. Now, those bonds are landing somewhere, and they're landing in the pension funds and elsewhere, which means that they now have to rebalance a little bit. And so what pension funds have been doing is bringing their weighting back to their expected weighting. So if it's a 60-40 weighting, they'll be bringing it back to the 60-40. But that means on the other side, they're buying equities, which explains why equities have been going up, when everybody knows the textbooks say equities go down when interest rates go up, but they're behaving in this paradoxical way of doing the opposite, simply because the amount of bonds is going up, and on the other side, the value of, or the amount of equities have to be rebalanced in the portfolio. So I think that's what's going on with equities, but we have a problem going forwards, and that is that the governments, and I'm referring mainly to the US government because that's the one I'm looking at most of the time, the US government needs to borrow $2.1 trillion in the year to 30th of September 2024, according to their own numbers, in order to fund the deficit for that year. So that's an extra 2.4 trillion over and above what they've borrowed already. That's a huge chunk of change relative to the total amount of bonds which they've issued previously. If we look at it in terms of the number of bonds relative to what's held by the public, it's about another 10% held by the public has to be acquired. And I think public at large, that's you, me, your pension fund, the government of China, England, Turkey, anywhere else on the planet, are starting to get indigestion, and they don't want to fill their boots with any more bonds. And that is why, as the government is borrowing this money, it's forcing up the interest rate, because they have to pay more to persuade the next guy to come in. And I've done some maths on the back of an envelope here, and it was quite detailed maths, but I figured out that the US bond yield, which is about the 10-year bond yield, I'm looking at the screen here, it's about 4.3 at the moment.
Yeah.
I figured out by the end of September next year, that will have to be 5.1, unless the Federal Reserve steps in and starts practicing what's called yield curve control, or quantitative easing by another word. Unless they step in and start buying those bonds off the government, we're going to see higher interest rates, a full percent higher nearly, by this time next year.
Yeah, I noticed as well. I saw an article on Bloomberg yesterday that the Bank of Japan is still doing a lot of QE. If they keep the same pace that they're doing QE, well, they call it yield curve control this year, for 2023, it's going to be a record high in terms, almost $900 billion of buying bonds. So yeah, I don't see like a way out for the central banks. I'm not sure what's going to give them the pretext to do QE or yield curve control. And it's interesting that the day that we're talking today is the day that we have this BRICS summit that's been a lot of talk about and speculation. But I've tried to tell people over the years that what the end of the petrodollar and de-dollarization would mean is less demand for U.S. bonds from foreigners, because they won't need as many dollars, and also for the satellite states of the U.S. like Germany, the U.K., Italy, and France. And I was just looking at the bond yields for Germany, and I used to trade the Bund market. That was one of the markets that I traded the most back in the 90s, 2000s, and 2000, up to 2012. And I saw that up until last year, the 10-year Bund yield was negative, which is, of course, crazy. Yep. Even the Italian BTP, which I traded a lot, it was near zero. And I remember back in 1994, and you probably remember as well, there was a pretty heavy bear market in bonds, short-term bear market, because at the time when you had bear market in bonds, it was like a chance to buy bonds because we were in a secular bull market. But I remember that still remember that the Bund future, which is the Treasury future equivalent for German government bonds, their notional coupon for the future is 6%. So I think right now we're around 2.7, but there's a long way to go. And these bond yield charts, they all look very bullish, which is a bad thing for prices. And yeah, and the thing that's worrying, Clive, and I'll let you in a second, is that what these low yields did in the last, well, since 08, 09, is allow governments to indebt themselves massively, and the public as well.
Can you see the screen I put up with the bond yields?
Yeah.
So just running through these very, very quickly, the top left chart is the UK 30-year gilt, and you can see that that is pushing almost, it is at the level where we had the crisis, the gilt crisis back in September, October 2022, and it's pushing higher. The next one in the middle, at the top, are the European 10-year bond yields, which is the same as the German bond yield that you talked about just now, which is 2.7% and rising once again, it's passing through the recent records and will be a record for many years. It was negative a few years ago, as you said. The next one on the top right is the UK 10-year gilt chart, which has already, the yield has already passed the crisis of September, October 2022 and heading higher. We're at 4.72% now on the sterling 10-year yield. Bottom left, I put in Sweden, where you can see the yield is moving up. It's about 2.8 something percent, but it's also at a high. The Japanese 10-year government bond yield in the middle left, middle bottom, that's moved up. It's now 0.66%. We mustn't forget that not so long ago it was negative. You can see that on the chart down at the bottom. It was minus 0.3 at the beginning, before 2020. And the last one I put up is the 10-year yield of the USA, which again is making new high yields. That basically means bond prices are down. The yield on the US 10-year is now 4.33%. So what we're seeing is all around the world, yields are moving higher. And the reason they're moving higher is simply that the appetite of the public to buy all these bonds, which need to be issued by the governments, is that people are getting indigestion. They can't take any, they don't want to take any more except at much higher yields.
Yeah, and I think you wrote about as well how it affects bond prices and consequently, balance sheets of banks and central banks. Could you share that with us? I think you were talking about the 30.
I don't know if I wrote about that, but what obviously does happen is banks do own these long-term assets, such as a 10-year gilt. That's one of their assets. So when the yield goes up, the corollary of that is the price goes down. That means the banks can't actually, their asset might be valued at 100, but it might be only worth 70 or 60 because the yield on the yield has gone up and the bond price has gone down. What that means is their assets and liabilities are no longer matched because they have short-term liabilities, which is you and I depositing money in the bank overnight. We can draw it out at any time, at least we think we can. But at the same time, they've invested our money into not only 10-year gilts, but they've also lent the money on mortgages at fixed rates. They've lent it to corporations at fixed rates, which means that although we see the bond prices are in a face, we see them going down, a loan that you've made to somebody on a mortgage at fixed rate, or a loan you made to a corporation at fixed rate, it may not be in your face because it's not marked to market, but realistically, it's worth less than you lent the person, and the bank ought to be very happy to buy your loan back at a discount. Now, they're not going to actually do that, but what it does mean is the banks are, their capital and the reserves are being eroded. And potentially some of them are insolvent, as we saw last year, and maybe some will become insolvent this year, as their assets go down in value, but their liabilities do not go down in value.
Yeah,
so it is hurting the banks.
Yeah, so I've got here what you wrote. You said, for example, the UK 50-year gilt, and there are some countries like Austria who issued 100-year bonds, but it says the 50-year gilt is down from a peak price of over £200 in October 2019 to just over £33 pounds now, down 84%. That's a government bonds. And some people might ask, why were they buying these bonds at these ridiculous prices and low yields? Well, because at the time, most people, and even today, some people still think that bond yields are going to go back to zero. And I think it might if the Fed does 20 trillion in QE, but then the dollar and all the other currencies will be toast. But the reason they were buying this is that a 50-year bond, the higher the price goes, or the lower the yield goes, the quicker the price moves up. So it's called duration, and it became like a speculation. They were buying just for the capital gain. But I think a lot of people, Clive, that did this, and even people who manage money for others, they didn't expect the bond market to turn so sharply and quickly as we've seen in the last 18 months. Is that your view too?
Yeah, well, when something's rising in price, so we had this 50-year bond was going up in price because of the lower and lower yields, and people, because it had a long duration, 100 years on the principal, that was the bond which was moving the fastest upwards. So people were buying it to thinking they'll sell it at a profit. And if it starts to go the wrong way, they also thought they'd be the first to sell. But that's not realistically the case, because when it has its first dip, people think, oh, I'll just wait till it gets back to its old price, then I'll sell. And of course, it never got back to the old price and started going down like literally in a straight line. So those people who bought these very, very long duration bonds have lost a lot of money. But there's another group of people who've lost a lot of money in the bond market, and those are the people who own bond funds. Now, a bond fund to the man in the street is probably even scarier than owning a bond. At least if you own a bond, you know when you're going to get repaid, and you know what your interest rate will be, even if it's not as much as you could have got in a money market fund. But at least you know, okay, it matures in 3 years. I'll get my money back in 3 years. It's a pity it's only paying 2.5% when I could have had 5%. You know where you stand. But if you own a bond fund, you don't know what the fund owns. It could be owning that 100-year bond. It could be owning all kinds of things. But the one certainty is that when you look at the price of your bond fund today, your bond fund will virtually in almost every single case be way below what you paid for it. And people are starting to say, have I made the right decision? So what's happening? They're ringing the banks and saying, you know what, Mr. Bank, you told me to buy this fund 2 years ago, 3 years ago, 4 years ago, 5 years ago. I've had it for 8 years. Not only has it done nothing, it's worth less than I paid. Sell it. I don't trust these people. So we have a wave of sellers out there. It's not in one go. It's slowly and steadily, but people are just basically bailing out of their bond funds, and that's putting pressure on the bond market. So I think in all respects, the bond market's going lower. Firstly, because people are disillusioned by that and they're bailing out. Secondly, because the governments need to borrow more and more, which basically increases the supply of bonds. And thirdly, we're now in a situation where there's a level of distrust coming into the government's ability to repay. And I don't know if you saw this, Mario, but yesterday in the Financial Times, there was an article which attracted my attention a lot about how Greece screwed over their bondholders, and I read it in great detail. I also went to the background papers in it because it interested me an awful lot, because I happen to have been back in 2012 a bondholder of Greece. Now, to do it justice, I bought this bond way below par, and Greece was already in trouble, and I fully expected to get a haircut. So I knew what I was doing, and I wasn't being crazy buying the bond of a bankrupt company. I expected to buy the bond, earn some interest, and then get a haircut and hopefully end up making a few bob. I kind of expected, and I think the market expected, to get a haircut of perhaps 40%, and even at 60% haircut, I would have still made some money. But what happened? They changed the rules midway at the behest of the ECB. And the way they changed the rules was to say that all bondholders do not rank pari passu. In other words, it would have been 1 vote per bondholder. It would have, if they have a liquidation or a default or a haircut, all bondholders would have been treated equally. They changed the law in Greece so all bondholders were not treated equally, and they changed it so that if a majority of the bondholders voted to have a different restructuring, it would be paid out in a different way. And the ECB happened to hold the majority of these Greek bonds because they've been buying them from the banks to bail out the banks. So the ECB then voted along the lines of, you pay us 100% ECB, and everybody else gets virtually nothing. And I can't remember how much I got, but I think it was about 10%. But it wasn't a real 10%. It was 10% divided up into about 30 bonds with very long durations and very low coupons. And when I was very, very annoyed by this because I hadn't been treated equally. The ECB had got favorable treatment by being repaid 100 when everybody else on the planet got repaid 10. And so this is my warning to you. If you buy a government bond, they could change the rules on you, and you don't know when they're going to do it or if they'll do it, and you might not get what you think you're going to get. It's not necessarily what's written on the tin. And don't forget, Greece was a European country where you wouldn't expect this sort of thing to happen.
Yeah, one thing they can't change is how much your double florin, your double shilling or your florin's worth, or even your little gold nugget here, which I bought
lovely.
years ago from Australia on eBay. It's 2.7 grams, and I remember when I bought it, it was 2.7 grams, so they can't change that. And that's why I keep saying you need to have a little bit of, well, it's not advice, but I think it's important to have some gold and silver. And there are some people now who think, well, bonds are good because they're yielding, 5-4%. But don't forget that they're probably going to be yielding a lot more, and that's going to impact the price of the bond a lot more. And what you need to understand as well, the longer the maturity of the bond, the riskier it gets, because the price could change very sharply. You buy a 10-year US Treasury at 4.3%. I don't know where the price is, maybe 90. But if it goes to 5, the price will drop to like 75. While on the 2-year note, if the yield goes up, the price won't move as much because the maturity is right around the corner. But even the short-term bills and the short-term notes, I don't think they're a good investment because, like you said, they can change the rules if there's a crisis. And the other thing, I don't think their yields are really covering the depreciation of the currency.
A couple of times ago on your show, I've said that higher interest rates are bad for the gold price, but not necessarily so. In fact, last night I took a decision at the close in New York to buy the GDXJ, which is an ETF investing in gold mining junior companies, the small gold miners, which is a very leveraged bet in a way on the gold price, because small gold miners rise a lot if the gold price rises. Now, a lot of people say that's an absolutely crazy investment because interest rates are rising. It's always been bad for the gold price when that happens. But the question I've got, and this is the speculation, all this money which is leaving the bond market, where's it going to go? Are they going to go into cash and effectively see it eroded by inflation? Are they going to go into equities and suffer from the huge swings, or are they going to see the gold price as being the safer bet? Now, I don't know the answer to that. I'm not telling people that the gold will definitely go up, but that was my speculation last night. And in terms of quantum, I only put about 0.5% of my investable money into that. It's a very small but speculative investment. But I think it's a good time to start accumulating gold. And certainly if the gold price goes lower, I would acquire more. But on the other hand, I'm thinking that the gold price has already come off $100 or more than $100. It's perhaps not a bad time to start accumulating.
Yeah, and like I said in the beginning, Jim Sinclair always said that if you really wanted to have a major bull market in precious metals, you needed a bear market in the long-term treasury bond. He meant the 30-year bond. But most people now look at the 10-year. The other thing I would say, in the 70s, bond yields were going up. I mean, they went from around 4 to 5 all the way up to 16 by 1981. And gold went from 35 to like almost $900. I think what the gold market doesn't like is Goldilocks, or a period where, like in the 90s, even the 80s, where the real return on bonds is really good, and you can get the compounding that you talked about earlier. Clive, just usually when I do my daily videos, I look at the markets at the end. So do you mind? I'm going to share here. Actually, people are going to see where I get my information from here. So there you go. It's from IG. So as you can see, it's 8:10, 10 past 8 a.m. London. So here we go. We've got spot gold. It's trading back to almost 1900 here. We're at 1899. It's up only 4, but the high's been 1900, the low 93. And I noticed yesterday that silver did really well. Today, it's kind of taking a breather. But yeah, silver's up about 3 cents. And the stock market, I mean, that's a place that, like you said, it's a dangerous place to be, and paradoxical at the moment, because last year was probably the worst year for the 60-40 in like decades. But this year, it looks like the NASDAQ is holding up. But yeah, they're up a little bit here this morning. As you can see, the Dow's up 30, NASDAQ is up 32, and the S&P up 7. And then the currencies, we got the pound up 0.25%, 127.85. I'm not sure why it's up a little bit here, but the euro is up as well, 0.25. And the dollar is down versus the yen. What's your view on the yen? Because I think what the Bank of Japan is doing might be what the US and Europe will start doing, the yield curve control. And the thing about the yen is that the price of gold in yen is like zooming up to all-time highs.
Last night I happen to have some yen, and I sold them to buy this ETF in America, the GDXJ. I think the yen is going to go down, and I think it's going to go down because their interest rate on their bonds and money market are as close to zero as you can get it. So it's 0.6 on the 10-year. It's a very unattractive yield compared with their inflation rate, which is about 3%. And because they're engaging in all this yield curve control, it basically means the central bank is printing money to stop the bond real yields rising. So the central bank is buying bonds, and it's buying them with newly printed money, which is shoving money into the system, which is devaluing the yen. So I personally wouldn't want to hold the yen. I mean, I don't have a problem with holding Japanese equities. That's not a problem because they benefit from a lower yen. But as far as holding the currency, I think it's a fool's game. And I had sold a little bit of an equity, and I got some yen. So I immediately shoved that into dollars and bought something connected with gold.
Yeah. So let's look at some of the other currencies that we look every morning. The Aussie dollar is up 1/3 at 64.37. The dollar is down a bit versus the Canadian dollar, and the Kiwi dollar is up 0.5%, just 59.55. And the commodities, oil is still fairly strong, but we've come off in the last few days. WTI is trading just above 80. And Brent is at 84.17. And I've noticed at the pump here in the UK, prices are starting to creep up. Can
I make a comment on the oil price, Mario?
Yeah, sure.
The US government has been, until fairly recently, suppressing the oil price by selling off its strategic reserves. They don't have that much left to sell. So I think the oil price tendency will be more likely up than down.
Yeah, I've got this chart here for crude oil, and this is when the U.S. government started selling its reserves, but now it's breaking out of this falling wedge, which is a bullish thing, I think. So yeah, and copper, I think we look at copper, that's still below 4. It's up almost 1% at 378. And platinum, some of you like to look at platinum, that's up 6, trading around 920. And let's just quickly look at the U.S. 10-year yield this morning. Yeah, we're at 4.34. The high has been 4.36.5. I think if we close this week above 4.4, I mean, I think the high last year was around 4.33. So we're testing that level right now. So I guess we can also look at the UK bond market because it's just opened. See what it's doing. So we got the 2-year at 5.28. I think that's still below the recent high around 5.5. And then the 10-year is almost at 4.80. And the 30 years, I think they're trying to keep it below 5, Clive, but it's around 4.8.
So the 10-year has gone up another 8 basis points overnight. So the 10-year yield is still rising in the UK.
Yeah. So, Clive, thank you for coming on, and maybe some last words for the viewers from you.
Well, thank you. First of all, thank you for inviting me, Mario. And on the bond side, we have a steady trickle of people selling their bonds. It's like sitting in a smoky cinema, queuing up for the exit. The stampede hasn't started yet, but there could be a stampede, and it might go downwards. The bond prices might go down very quickly. So if I was a holder of bonds or a bond fund, I'd be out.
Great. Thank you very much, Clive, and have a great day.
Thanks, Mario. Have a nice day. Bye-bye now.
Bye.